Welcome to Getting Rich with Rich. I'm Rich, founder of Under the Radar Report. Well, these are certainly interesting times. Share markets hitting record highs. Meanwhile, we're all feeling the pinch. How is this so, as Professor Sumner Miller might ask? Well, basically, we're in a Goldilocks scenario. That is not a fairy tale, although it could be, but it's a financial markets term, not the most technical of terms. But it's like when we've had a huge night and there's no hangover. That's harking back to my Beers with Rich days. Basically, the inflation genie is being kept in the bottle. So we're not getting killed by inflation. And that evidence is found in statistics coming out like producer price index statistics in the US and here, and also CPI statistics. So that's giving the market confidence that inflation isn't going to wipe out everyone's wealth. Meanwhile, because of that, we don't think that the interest rates are going to keep going up. So the bonds are rallying. So interest rates are coming off. Also, meanwhile, unemployment's not out of control. So we're not rich, but we're not going broke because most of us have jobs. So unemployment rate is around 3.5%, 3.75% or something, projected to go up to 4.5% or something like that. But it's not out of control. So basically, growth is still there, albeit anemic. So the point is there's still growth. So everything's like not hunky-dory for everyone individually, but overall, we're not in too much pain. What does an investor do in these circumstances? Well, as usual, I'll tell you what I'm doing. I bought 2 stocks from our dividend portfolios. These portfolios basically have outperformed year after year after year. So I bought 2 more of the ones that I didn't know. New Zealand Media, which owns radio and newspapers in, you guessed it, New Zealand. Count Limited, which owns and services financial planners. Before I get into some detail about those businesses, it's important to point out that the market's not representative of many stocks. So basically, we've seen this huge gain, but does that mean that, everything's expensive? No. There's never been more difference between the big companies promoting the index and the rest of the market because there's so few of those companies. Even at the big end of town, there's value. But on the other hand, some of those stocks that have been pushing the market are looking pricey. Like we've been backing Westpac. Westpac's a bank in the cartel basically in Australia, but it was like one of the poorer performing banks. So we thought, okay, reversion to mean. These guys are similar in an earnings profile to CBA, but they're trading at a huge discount, get a good yield, so good value. That stock has returned almost 40% in 12 months. I mean, you heard that right. So basically, we're not going to keep buying Westpac, but, we still hold it. So there are stocks that are getting on the pricey side, but there's value still in small caps. Some small caps shooting the lights out with Southern Cross Electrical, of Integrated Research and more, but there are many more that are still value. And 2 of those stocks, look at their charts, New Zealand Media, Count Limited. Both are in industries that have been on their knees, where they've been in turmoil. Like, everyone knows traditional media's been a struggle. Everyone knows financial planning has been in a lot of trouble since the 2018 Royal Commission. Basically, these are survivors. So these are trading on very low cash flow multiples and they're consolidators. So especially Count Limited, CUP, they've bought like a company, they've increased their size, their reach by 50%. So, we're waiting for that kind of benefit to come through. In the case of New Zealand Media, well, they're on a 9% dividend yield. That's before you include the tax credits. So they don't have to do much at all, to improve my portfolio. And in fact, I'll be reinvesting those dividend yields every day of the week. That's just great. A great return, like basically similar to what Warren Buffett was getting when he bailed out Solomon Smith Barney. Arguably at less risk. The point is, if you invest in some high-risk companies, the sum total of the risk isn't nearly as high. That's what hedging's about. And in investing, that's called diversification. That's what I do. That's what Caroline Mark does. and she's more than doubled her money in 5 years after starting from scratch. Listen to her on the Shares for Beginners podcast. I really recommend it. Great to see you again. I look forward to talking to you next week.